Aniruddha Sarkar, CEO and Portfolio Manager at Quest Investment Managers, joins us right now on the show. Aniruddha, good having you. Thanks for joining in. I would love to know how you are thinking about this whole landscape currently, Aniruddha, because it seems like the Indian markets are being meted out for a special punishment, and the broader markets continue to reel lower, irrespective of whether the global handover is strong or no. What's your sense of the landscape currently?
Yeah, hi, good morning, Niraj. I think, what we have been seeing for the last couple of months is that extreme pessimism. And, like they say, in the good times, bad news gets discounted. In the bad times, good news gets discounted. So what we saw that, in fact, if I just go back and see, so the big concern which was there for India was the valuations and earnings. So basically, the two were not in sync. India used to always, see that 16, 17, 18% kind of a growth over the last 4 years. And that is where the premium which India enjoyed compared to the rest of the world, that was justified. FY25 was something which was not a great number with regard to the earnings. That 16, 17, 18%, it went down drastically. First quarter we had almost like 8% kind of a growth. Second quarter was completely flat. And that is where the big concern picked up, that if you're not going to see those double digit kind of a mid teens to high teens kind of a growth, does the premium justify for India? Yes, I would say that it was not right to be putting at those multiples. But yes, if I see where the price damage has happened, I think valuation-wise now market looks definitely very attractive. But as they say, at this point of time, there is absolute absence of the buyer on the screen, and which is evident if you look at the price damage on the volumes. I think volumes are extremely low. So I would say yes, there is a bit of a panic, but valuations on FY26, FY27 is getting more and more attractive.
Aniruddha, the valuations are getting attractive for just the Nifty 50 companies, or are you finding valuations attractive even in the small cap space selectively? It will never be index wide, of course, out there.
Absolutely. So I'll say that, even when we talk about the large caps, there's a huge difference in the returns and the numbers also for the Nifty 50 and the Nifty Next 50. Now, a lot of debate has been happening that, the large caps are doing better than the small caps and mid caps, etc. But if I just look at the Nifty 50 and the Nifty Next 50, they both are large caps. Now, interestingly, the Nifty Next 50 has fallen almost in line with the Nifty Mid Cap Index over the last couple of months, though it is a large cap index. So I would say that beyond Nifty, even the next 50 large caps are also declining. So having said that, I would say that if I look on an FY26 and on FY27 numbers, small cap is also looking very attractive. So I'll just talk about the index, with a valuation perspective. So if I talk about the Nifty Small Cap 100, on FY27, we are roughly at around 17 price to earning, which compares to around 16 price to earning for the Nifty 50, which means Nifty 50 is quoting at around 16p on FY27 numbers, and Nifty Small Cap 100 is quoting at roughly around 17p. Mid Cap Index is slightly higher. Mid Cap Index is quoting at roughly around 21 times on FY27. But yes, I would say the market in whole has become much attractive compared to what it was a couple of months back. Individual companies is where the value is much more attractive, but I'm not sure when the recovery will happen. But I would say that for any investor who's looking to buy, I think the valuation of companies has become very attractive. There are many companies which have fallen much below what they were the lows made in the COVID. So I think, and yes, we had COVID almost 4 years, 5 years back, and over this period there has been earnings growth. Some companies were very expensive, so the fall was justified. But yes, there are companies which are looking attractive after the recent correction.
Okay. And that would be, I mean, I'm glad you point that out, because it's not that the whole universe of large caps is safe and the whole universe of small caps is looking wobbly. Now, I would love to know, Aniruddha, when you're saying that some companies have started to look attractive, is it a factor of they reiterating their growth in quarter 2 and quarter 3 and valuation still having fallen? And if that is the case, what are those buckets wherein the growth guidances have been reiterated or enhanced, as the case may be, or have pulled back just a little bit, but the fall in valuations or the multiples has been very steep? Which buckets?
So I would say the two buckets where I've seen a lot of the price damage owing to the valuations. One is the capex space, anything to look which is linked to the capital goods. Second is the consumption basket. Now on the capex side, I think we are all aware that the first half of FY25 was extremely weak on the capex. We have to blame it on the elections because typically in an election year, 4 5 months around the election, capex activity is weak. It should have picked up from August, but yes, we didn't see the pickup all the way till December. Now, if I look at the rebased number for this year, which is this FY25, the rebased number, if we have to achieve, I think we should see almost like an 18 to 20% kind of a Y-on-Y jump on the capex in this quarter, which is the fourth quarter. So Jan, Feb, March, this quarter where we are, I would say that we should see almost like 18 20% jump on the capex. Next year, the full year estimate is almost like 10% growth on this year's the rebased number. So I will say the capex is one space, capital goods, infrastructure, overall the government capex, which has been hit hard with regard to the valuations and the price correction. But this is on account of growth not being there for bulk of the last year. That is where I see a lot of the recovery happening. Order books have been strong. Execution is the key, because without execution, order book has no meaning. So I think that is where order books execution picking up is going to be a big trigger. And I think we'll see good recovery on entire space where anything to do with the government capex. The second big area where a lot of damage has happened is on the consumption side, because consumption, as we know, has been weak the last year. Earlier, we used to talk about the rural consumption being weak. Last 1 year, I would say the urban consumption has also been hit. Part of it we have to account with regard to the income growth, which has been below the inflation. Part of it we have to also account with regard to the wealth erosion which has happened, because wealth effect is a very important aspect when it comes to the consumer discretionary spends. So I would say with wealth effect damaging the sentiment, I would say that is where some recovery should happen only when the market recovers. But broadly, I would say with the tax incentives which the government has given, I think consumption in the middle class is something we should see picking up from April of this year. Just this, kind of the basic maths, with the tax incentive which has been given, broadly 20 to 25% in hand, your income will be increasing from 1st of April. So that is a big jump for any middle class. If you get a 20 25% jump in your in hand income per month, typically this goes into the low ticket consumer discretionary items. And I think both of these areas, capex and consumption, which has been hit for most of last year, should see some recovery.
Got it. It's interesting you mentioned capital goods. I would love to know, I mean, it's a very wide bucket, Aniruddha. When I look at the commentary that is coming from companies, the power related cap good companies or that whole chain seems to have still reiterated growth numbers, not just for Q4, but for FY26 and 27 too in some cases. Is that a bucket within cap goods in the small cap space, the ancillary chain, or is it something else?
Absolutely. I would say you picked up the right sector within the cap goods, because I'm betting mostly on the power capex, because power is one area wherein government focus has not reduced. And if I look at the amount of power capex which is happening, I think the entire ancillaries to the power space is where the growth continues to be extremely strong. And there's a lot of visibility, at least for the next FY26, FY27. And I would say that with the type of price erosion which has happened, valuations have become very attractive. In fact, a couple of the power capex companies, they are now at almost the one-time peg ratio. And that is where I would say the attractiveness has become more and more higher at this point of time.
So, Aniruddha, tell me this. Now, we've spoken to a clutch of managements, right? The view, the dichotomy that comes into this space. So, for example, transformers. Managements have said that FY26, 27 looks okay. Margin guidances have been maintained. But people who track this space closely say that a lot of capacity is coming on stream. And therefore, margins which had gone up from whatever 10, 11% all the way to maybe 16, 18, 20% in select cases will all start coming lower. The managements are saying that will not happen. I'd love to know, if you look at this pocket, let's say, for example, transformers, what's your sense?
Yeah, so basically, I think, there will be, I don't see a margin expansion happening from where we are. I think the peak margins are where we have reached. on that space. But I don't see the margins coming off drastically because see, typically even the power capex, the transformer capex which happens, it takes time for the capacities to come on stream. So and within the transformer capex, I would say we are betting on companies which have a huge moat around itself with regard to the size of transformers they are betting on or they are able to produce. So I would say the small size transformers, yes, competition is high. You could see some amount of competitive intensity eating into the margins. But when it comes to the large HVDC orders and the large transformers, I think entry barriers are very, very high. And that is where I don't see the margin compression happening. So yes, we are betting on the bigger players who have a huge moat around themselves.
What about the other streams? And I'm sticking to power simply because there's only as much that we can talk in the limited time, right? So let's say grid manufacturers or equipment suppliers to wind energy, for example, or solar module manufacturers, again, that whole bucket. So 2 or 3 that I've invoked here, Aniruddha. Any thoughts on any of them?
See, solar as a space, to be honest, I think valuations had gone way beyond what was the ground reality, and that is where the price damage has also happened much more. Because I think what happens typically in a bull market, we have all seen, you pick up one hot theme, and anything and everything around that hot theme, it starts getting obnoxious valuations, and only when the things hit the roof, then we realize that yes, these numbers are not achievable, and that is where the price erosion also happens more. So I'm not too bullish on the whole solar space with regard to the the companies which are into the modules and etc. I would say if an investor is looking to bet, he should rather bet on the ancillaries, which are the intermediaries of power production, irrespective of the source of power production, whether it is the renewable, the hydro, the nuclear, the thermal, irrespective of the source of power, one should bet on the intermediaries because that is where your cycles will not be dependent on, which source of power is getting more capex and whether there are any concerns over there. Having said that, I think one good area where I think, very difficult to find many investable ideas, in fact, we are also exploring, is the nuclear space, because that is one area where definitely the government has a lot of focus with regard to the nuclear energy. But yes, there are not much investable ideas as of today. The other area where I would say, we had all the news in the recent days with regard to the wires and cables. See, wires and cables is something which, yes, the large player is coming in with a large capex, but it would take time for the capex to happen. But yes, I think definitely a lot of the valuation correction has already happened in many of those players. But all in all, I think, transmission is one big area where the demand for wires and cables will only increase. So again, there we'll have to look at companies who have a very clear moat. So basic idea is you should not bet on companies which are into the commodity products or where the entry barriers are very low. Look at companies within the power space where either it's not a commodity play or it's not, or the entry barriers are high.
Okay, Aniruddha, lovely talking to you and good to hear somebody who is following the market for the valuations and not just the narrative around small caps. Great to have this conversation today. Thanks for taking the time out.